Welcome back for this special episode of the CRECo.ai Real Estate Roundtable sector interview with Art Rendak. The Real Estate Roundtable is your all-in-one comprehensive view of what's happening in the real estate industry, straight from some of the industry's earliest technology adopters to foremost experts. I'm Andreas Senie, founder, CRE Collaborative, brokerage owner, and technology growth expert. Joining me this month is none other than Art Rendak, President, Inland Mortgage Capital, LLC, a member of the Inland Real Estate Group of Companies. Art, so great to have you here. So many questions. We're going to get into them. Do interrupt me on your background if I misstep it, but I'm going to give it my best shot. Art has been in real estate finance, 20 years now at least. First in various banks in Virginia, and then with Inland since 2000, handling everything from underwriting to building loan portfolios to creating the first PACE program in 2015, 2017. Having navigated the last great financial crisis, wherein you actually established Inland Mortgage Capital, making it one of the most reliable small balance debt funds in the U.S. Suffice to say, I consider you a foremost expert in lending as we head into this economic downturn.
Well, thanks for having me. It's been actually longer than 20 years. It's been like 30, 32, I think, if you want to really count my first day at the bank. But before that, I was an accountant, I guess. So I'm a reformed accountant, CPA, and I was working for a finance company a long time ago. And I decided that I'd rather get the checks than sign the checks. So I moved from accounting to finance, and the rest is sort of history. It's a crazy story how I got in the business, but at least on the real estate side, I was on the sort of the commercial M&A financing side when I first started, and just got a really lucky break to get into real estate, and thankfully it happened because I love what I do and love real estate.
Well, and you love Inland, clearly.
I love Inland. Yeah, 22 years here. It's been two crises, I think, which isn't too bad in real estate. I don't know. Yeah, the pandemic I would definitely describe as a crisis, and hopefully we're not going to enter into a third one here. I guess we'll probably talk a little bit about what's going on in the future.
Oh, absolutely. Well, real estate, as you know, it's a cyclical business. We have our ups, we have our downs.
Yeah, I think this is my fourth, depending on how you define some of them. I think the .com bubble was it definitely affected office. And then the early 90s when I first started, I was a workout guy, and that was the savings and loan crisis, I guess. So if you savings and loan, .com bubble, the great financial crisis, and the pandemic, I guess I count that as four.
Well,
but that's a lot of good years in between than that 30-some years. So.
Well, and that's right. It's a lot of lessons learned, I imagine, going from high leverage to what you focus on now, which I understand is bridge loan programs, 3 to 15 million non-recourse.
Yeah. 3 to 15, a little higher sometimes, not much lower than 3. It sort of doesn't make sense at that level, but nationwide, all property types, more or less. So yeah, we're excited about where we are in the space today. Just like the cycles and we've seen in the macro levels, sort of, it's nicer to be lending in a market where other people are sort of sitting on the sidelines. And I've always enjoyed these kind of times when I have capital to deploy and other people seem to not have it. So it's good.
Absolutely. I got my brokerage license in 2007. So I cut my teeth in real estate during a crisis, which was great because there wasn't any riffraff, so to speak. There wasn't this plethora of options or people trying to do things. There were serious deal makers out there working deals, doing deals. So you said something interesting there. You said you have capital, others don't. So Inland's obviously out there buying, developing, lending. You're busy. What are you doing, or what's changed in your outlook over the last 6 months as we head into this shift?
I think for us, we were still sort of recover. I wouldn't say recovering, but just sort of evaluating what we wanted to do coming out of the pandemic. We've definitely slowed down the last couple of years, and so was as thing is, we restructured the kind of debt we wanted to have. Where most people in the debt fund business use warehouse lines and other. We don't have bank depositors to help us, as you know, provide capital to put out to our borrowers. But so we just sort of restructured everything after the pandemic, looked at things a little differently. The pandemic, like most people, I think we're fortunate that luckily we made good loans pre-pandemic and they survived, and so we'll have a perfect track record of that portfolio. And now the job is we've already started, but the job is to replicate that again. And luckily for us, as we've had a ton of payoffs from the legacy portfolio, we have a lot of capital to deploy. So and going to your question, Andreas, it's clearly, if anybody's read the headlines, knows that lenders are a little, I wouldn't say frozen like the great financial crisis, but I think they want to maybe a little stagnant. I don't know if that's the right word, but there's just uncertainty. Uncertainty is whether you're a buyer of real estate or an owner or you're a lender. It's a challenging time, and it's that doesn't it makes my job, even though maybe I don't have as many competitors bidding on the same loans if they're good deals. It's still we've got to evaluate those deals, see if they can survive. What I hope is a short term.
So is it fair to say that the lenders are letting off the gas in the time to close, or are they dragging their feet, so to speak, as interest rates come up? What do you think is going to happen?
It's I don't sit in the seats of a lot of lenders. I mostly it's anecdotal. I was just on a web Zoom call this morning, and one of the panelists was a major borrower here in Chicago area, and he said that all his money center banks told him that it's only for the best and the brightest they're giving really serious looks. But I don't believe that is it might have been a little bit overstatement. But there's no doubt. I think CMBS is a challenge. They don't like volatility more than anybody. They they make loans and then they sell them or securitize them. And if the price goes, the yield goes up that the bond buyers demand, it's not a good time in the CMBS shop. So this is not a good time for them. Uncertainty of where the rates are going. Why do you want to buy a bond if for 10 years if you think tomorrow the rate's gonna you can buy one for 50 bips more expensive or more favorable to you as a buyer. So it's CRECo, which is another securitization product. Which is in my space, same problem. Don't know how the bonds are going to price when they get to market. So the pooling of the assets is one thing, but if you're not going to make money on the securitization, then it's not a good time. And so, but the good news is I think warehouse lending is probably fine, and the problems that cause sort of a cardiac arrest in the finance world, which we saw in 07, 08, are not there by no means. So, right now it's just a rapidly rising interest rate environment, which is causing a lot of hiccups in the lending world.
Are you seeing an influx in origination, people trying to get in under the gun as inflation, or there's enough volatility, they're pulling back?
I think it's the buyers have capital and they want to deploy it, and they, they're still trying to buy assets. I think it's just when they put the levered model together, and I'm dealing with folks who are probably, not going to buy something with $100 million cash and, clip a 5%, cap rate coupon. But so I think the folks who are using leverage in their analysis are, just stunned at the widening of spreads and things. So you've got negative leverage more often than not. I'm in the value add space, so what it means is that the value add has got to be much higher than it used to be in order to support where the overall yield is going to be. and it's
Absolutely.
only going to go up, even with interest rate caps and things like that. So it's the challenge on my side is not only is winning the business, but again, making sure the borrower can repay, and it's all sensible underwriting. It's like,
Well, and you, Inland, this bridge loan program, it's non-recourse, no
yes,
prepayment, no premiums, and you have, as you mentioned, you were the first to have a PACE loan program. You created your first PACE program. You were there, so in a sense, you have the end-to-end financing capability that another bank or lender may not provide. So is that going to be a big advantage as we head in here? As I understand it from Anna Maria, the CPACE loan is only becoming more and more of an add value given the changes
yeah,
in rates.
no, we weren't the first. I mean, just we were involved in PACE at a pretty nascent time, when there was virtually very little CPACE nationwide, and Resi was probably more prevalent, and we were excited about the product, still are. Obviously, we have a program, and that's is now pretty much focused on commercial PACE, but the exit strategy is it's the markets freeze up. It'll always be challenging. We all want multifamily because the government is a big lender for the exit, and the government has been pretty steady even during times of crisis, in meeting the agencies. And so the most liquid asset class by far is multifamily. Um, and we certainly can't, if we're going to underwrite to the belief that there's not going to be any capital to buy an asset at the maturity date, we shouldn't be lending money. So we sort of have a assumption that there's going to be some normalcy to the capital market, so that transactions can ebb and flow. And we just have to look at where rates are going to, using forward curves and things like that, try to guess what the debt service coverage is going to be 2 or 3 years from now.
Well, and as you said, you've been through 4 of these downturns, and I'll
Yeah,
just say it that way. You helped
yeah,
rewrite manuals at Inland, policy, reshape groups, underwriting, and so forth. Unlike COVID, which was a paradigm shift, no one expected that. They didn't know what to do.
right.
This part, coming out of COVID, up, down, rates are going up. This is business as usual. Fair to say, having
Yeah,
been through it.
and it's a good thing because I mean, you're here. If anybody who's been listening, and they also be listening to your podcast, it's the only one that
Appreciate that.
anybody should be listening to. But I think everybody who's been on some web calls about state of the market type things, we're hearing sort of this, especially if there's an economist on the panel. It's strange. It's you've got unemployment at the lowest levels ever. A great jobs report a couple weeks ago, and then you've got this inflation problem, and you've got rates rising, and you hear about credit markets pulling back, and it's a very we obviously there's a war sort of it is affecting certainly affecting Europe, affecting us as well here in the U.S. But yeah, it's a very strange time, and I'm more optimistic because we're going into this with a lot of good things. Savings rates very high, employment very solid. I assume there'll be some we'll see some unfortunate layoffs and things, and probably a tick up on the unemployment rate. But 5% used to be the number of full employment. Now we're at 3.8 or whatever it is. So we've got a 1.2 to go before we get back to the old days. Now, the old days aren't the old days anymore. But
Absolutely. I mean, look, even your points on your mortgage or whatever debt vehicle you're using compared to 2007, breathe on a mirror, pay 18% or what have
yeah,
you. We're prepared for this. We've learned a lot of lessons. There are a lot of
right,
controls in place. We talk a lot on the monthly show, the Roundtable show, about at least recently these labor shortages and other issues. And the question I want to ask you specific to COVID, with these developments shut down, with these large scale developments out there, are you seeing an issue with these owners, developers outside of Inland, these independents, kind of stalled, hard up for money now that they've been through COVID, they stopped working, then they started working, they didn't get those tenants in, they didn't deliver that space on time. loans are going to mature, things are going to change, especially short-term financing, hard money loans. What's your thought there? Is there I hesitate to say this for a negative connotation, is there a shadow inventory just waiting from the developer side? These mid-sized guys that are building out a couple hundred thousand
I
square
think
feet.
it's a great question, and I think that's why you're sitting in the city center. But uh, I think it's property specific. I mean, and again, the statistics you look at are backwards a little bit. Not too backward, but maybe the last quarter or whatever. But multifamily is just roaring, and
Absolutely.
if there's a risk, I think in multifamily, it's that rents are way ahead of cost of living, or at least wage increases. And we've all read the same things. Affordability has never been worse. And I think the average house price is 416,000 today.
No, it's
It's
with
insane.
institutional buyers coming in.
I
Absolutely.
think, to answer your question, I mean, I think office is really if there's a shadow wave of something that I'd be worried about, it's certainly office. And I go in the city of Chicago. I'm in the suburbs, but I'm in the city frequently. The building that we work in, which is we work at a WeWork here, that building is relatively empty every day. And I think the statistics say like 40% of Chicagoans are back in their office, at least in the city. But rent seems to be paid. There's delinquency in the office space is not bad at all. CMBS delinquency on office is not where I thought it would be. So people are continue to pay rent. Obviously we have vacancy where space is being sublet, space is being given back, and certainly in Chicago, I know that more than the other markets, we're seeing this incredible, marketing of vacant B buildings being marketed as multifamily conversion plays. But I think with all that being said, I think I expect to see those office buildings, in the CMBS space and such. I got to believe tenants will stop paying. It just doesn't make economic sense to pay for something you're not using. And I don't know if they haven't got around to it, or lease terms were just perfectly aligned with the COVID situation. But I'm shocked there's not more defaults in the office market.
Well, and defaults are simply opportunities for the next investor, right?
Yeah, but again, you got to buy it if you got the right basis and you believe that the office market's coming back. I think it's a great opportunity. I'm not looking at office, but it's got to be at the right basis where the rents are either going to be below market or something, and a lot of TIs are going to be budgeted, and you're really going to be able to buy those tenants and fill the space for those who want to have the work from office model. Yeah, I believe that office is going to come back, but my personal paradigm of I like to be in the office. I'm used to it. I've been doing it for 30 some years now, and I don't know if that's fair to assume that just because I believe it's a better way to conduct business doesn't mean that it's is going to be the way of the future. I do think it's going to there's going to be flexibility, even if we do see a shift change and away from sort of this work from home model. But and 3-4 days a week will be the norm at most.
Absolutely, the hybrid workforce come in 3, 1 off.
I'm telling you right now, it feels like 1 or 0. The trains to the city are still modestly, better than they were when I first in the middle of the pandemic by far. But I get my own seat. There's rarely any congestion at Union Station. So
that's a blessing, right? Public transportation.
Yeah, I guess with COVID and all that, but
yeah.
I think it's the way the city needs people. And you're in South Florida. I'm sure it's a little bit different because of
Northeast Connecticut.
Oh, I'm sorry.
My show originally with Jim Freed, South Florida.
I'm sorry. I keep messing that up. I apologize. But I walk past a lot of vacant, storefront restaurants, and there's just not enough people to support the 8 to 5, lunch crowd, breakfast crowd, coffee crowd. and names like have closed, and it's you need people in the city. You need the density to during the day to keep those businesses running and generate taxes for the city and all the other good things that happen. Lyft drivers have
at the
more
same
business.
time, we're seeing this hyper focus, partly because of that hybrid workforce, into renovating these buildings or even changing the overall structure for more of a home-like environment. It's got to be clean utilities. It has to be health first.
Yes.
And include open space, even repurposing or rezoning different areas so we can have these mixed-use developments. But to your point, if they're not getting on the train, they're not showing up into the city.
Yeah.
I wouldn't move into New York right now, and I'm from New York originally. Prices are great at the moment, but I like it here in the country, away from mass transit. But that's
the arguments for the stay at home are plentiful. I mean, it's an hour commute for some, if you live in the suburbs, and gas prices, obviously, and so you've lost 2 hours of productivity if you're sort of on a urban commute. And if my belief is that if companies don't sort of require their employees to come to the office, the ones who do come to the office are going to find it to be relatively deserted, like it is behind me right now. It's after 5 here, but
and you've got a generational shift.
You don't want people come to the office and they feel like they're being forced to come to the office that's relatively empty. They're just not going to have that same vibe. And I think some of coming to work is sort of that coordinated. Collaboration was the word of the year of 3 or 4 or 5 years ago.
Well, it's team building, and the Harvard Business Review had a study. We need to gather. We as human
absolutely
beings. Now, and I'm not going into the metaverse on this call, whether that's virtually or in an office or what have you in the future.
I don't know anything about the metaverse, so
me neither. And I'm a technologist at heart. I know it's goggles and it's coming one day. A Zoom is a great bridge. This ability to video conference. So speaking of Zoom, here you are. We're talking about whether to be in the office, not be in the office. With COVID and the adoption of Zoom and these tools to sort of blend work from home and work at the office, are loans closed? Are you able to write and close loans faster? I mean, what are you looking at for your close time typically as you're out there looking?
I'm old school. I come in the office, I read documents. But yes, my team is not here or was not here. Lawyers are obviously have been virtual for them. Outside counsel has been virtual the whole, for all the time I've been in the business. And it's definitely getting done. It's, earnings during the pandemic were terrific for the most part for many companies. Obviously the stock market exploded once it recovered from its initial, mess, but we're definitely. I mean, the technology allows us to get things done, and we email, and people read online, and they're able to work from home, and signing documents is obviously you can DocuSign or whatever. I don't want to plug some company or whatever, but
but it's faster. You're operating better.
Can be done, and obviously accommodations were made. I think probably its agency would never allow you to do DocuSign on your loan documents, and they did because they had no choice. So
and it's here to stay.
Certainly. Yeah, and it's all enforceable and all that. So I suppose there'll be some fraud in all this at some point, but hopefully not.
Very well. With change, there's always the error, right? There's certain error, there's certain fraud, but we're adapting. Regulators are there. DocuSign is a great tool. It's been around forever. Some of these new ones are a little tricky. Dotloop is another one. I will shamelessly plug a company or two here.
Okay.
For different reasons, but we're better. We're faster. We can work from home. We can work at the office. I, like you, I'm a bit of a traditionalist. I like the office. I also, as a broker, if you're not pushing your product front of mind to everyone on the phone, you don't know what's happening. Right. So the one thing I've noticed is with email and everything else, there's a lot to deal with. And so phone, in person, just fantastic ways to do business. Last I checked, still true today, I hope. But talk to me more about, you're back in the office, your team's not in the office. What are you guys landing on? What have you learned, or what do you plan on doing as we head into this downturn that's unique to your experience? What was the big lesson you took from the great financial crisis, the last one, as opposed to the prior?
Yeah, I think the sort of the value add, like transitional, the longer that takes for the project to get stabilized, the more risk there is. And so we all like, we us as value add lenders in the bridge space, we're lending on a story. We're lending on some, either it's a problem with the asset that needs to be fixed with probably capital and management expertise, or it's a property that was doing fine for the seller, but there's potentially value to be created through rehabbing, like mostly in the multifamily space, heavy renovation of a unit to generate more rent. And so the small space, we're not doing 500 unit projects that require extended period of time. If we're doing a transitional multifamily deal, we're willing, again, with multifamily being so liquid relatively to the other asset classes in our commercial real estate space, I think we'll take more risk on the level of transition, so to speak, in the multifamily space. And our deals are typically 100 units, something like that, 70 units. So we're, even if every unit's occupied and you've got to wait for the tenant to leave and, before you do your renovation, it doesn't take that long generally.
Right, multifamily shortest cycle to.
So you figure
first
6, 7, 8 units every month are gonna roll, and whether you ask the tenant to leave or you get them, whatever you do to vacate those units, you can renovate them to increase the rents.
So here in the Northeast,
the other asset property types, we're not as inclined to probably do like a lot of heavy lifting on those. I think self-storage I love the product type, and I'm looking at self-storage because the asset class has performed. In every downturn virtually. The issue is it takes so long for the stabilization, but I think we've seen the evidence over all these different down cycles is eventually it's the thing is there's so much product, much more so than it used to be when it was the barriers to entry were really much higher. But I still like the asset class, but it does take a long time. When you take a Macy's or some old department store and you turn it into 100,000 feet with 750 self-storage spaces, it's even at 20 a month, it takes a long time to get to 750. So that's something you got to think about. But we obviously we love the asset class and the way it's performed in the down cycles. We're definitely looking at self-storage.
And you took the words out of my mouth. Public storage, a great asset class. Then you've got warehouse space, something you're very familiar with, mixed-use projects, and hotels even. Are you guys doing any hotels? Anything happening in that space?
I think we're not looking at hotels, but I think we're extra cautious. Certain markets on the leisure side have done very, very well, never even hardly missed a beat. The ones who require business travel still seem to are not there yet. And so I think you need, I definitely look at one where the basis was at the right place. Maybe somebody picked up something at a good price and with good experience, and maybe can sort of resize the NOI potential for the leverage.
Well, similar multifamily, hotels, public storage. These are all short-term leases, right? You don't have a 10-year below market lease, 10, 20, 30, whatever it is,
right?
Locking you in. You can adjust up or try to catch up to inflation. Let's say it that way, or make these changes. Just as an owner, obviously.
No, I think you're right. Self-storage is definitely month to month, but it's pretty sticky for the. Again, I think we've got enough empirical evidence that yeah, there's obviously turnover every month of some level, but it's more often than not. And I'm a customer, so I know how sticky it is. My rent has gone up, a ton in the 2 years I've had my unit. But yeah, does it make economic sense for me to go over there and move to across the street to the other guy who's giving me 1 month free and lower rate? But I don't do it, and I think it's I'm guessing that I'm similar to other people that it's more work to move your stuff out of a unit across the street than it is to pay an extra $50 that doesn't make economic sense on. But,
No, it's a lot like data. Once it's somewhere, you want to keep it
yeah,
there. You have your systems. You're used to
yeah,
using it.
right.
Look at Excel for commercial real estate.
Changing cable or moving your, taking money, transferring to a new bank. Sometimes, yeah, you either get upset so much from the lack of service or something, but you find that it's so much work to do all your automatic payments and everything to change banks. You just kind of look the other way and go, God, the service stinks, but I'm too embedded in their,
System
embedded in my,
life.
my routine. Yeah. So, but self-storage hotels are definitely would be the tricky one. So yeah, if there is a difficult recession, I think we obviously know from history that is a tough asset class during a time when businesses are restricting travel or people are unemployed. They're obviously not going to stay at a hotel. So it's a tough, yeah. So it's a little tougher. That's why I'm saying I think we want to see the basis, and there should be some opportunities there. I would think. I think there's a ton of hotels that are being converted to not a ton, but I see a lot of those deals in my business. And you're not really sure about that. I think they've been successful. I'm a little I don't know about having a hotel with nothing but studios, and I don't know. I know it works, and we need the housing, and I get all that, but I just can't kind of get over it personally that we have no diversity in our unit offering. So
That's a fair point, and you're right. Anybody who's anybody will talk about how behind we are in housing.
yeah,
We were behind as a country on housing in most markets, if not all markets, practically before COVID. COVID simply accelerated this massive surplus of people out of cities into areas where housing was already a problem, and inflation and so on. The rest
yeah,
I know. So conversion, anytime we can take a hotel, an old mall, things of that nature, and convert it, why not? The
right.
bones are there. And it sounds to me like those are coming across your desk, and Inland's happy to pull the trigger. That's a good move. You're saying,
Oh yeah, I
let's
think
do it.
we're looking at it. I think it is workforce housing in many ways. It's units are small. I'm not talking about a raising of like a ultra limited service hotel. I'm just saying I think one closed, for whatever reason, maybe during the pandemic, and someone's picking it up at a good basis, and they're going to try to squeeze a kitchen in there and maybe upgrade the bathrooms, and you've got the amenities. Probably you've got a pool and maybe a gym and maybe some meeting space that you can turn into some co-working.
And the site work's done.
The
It's
site
already
work's
there.
done. You got a ton of parking. But you're talking about 350 square foot units or something like that, and 112 of them or something. It's just there's the micro thing worked. I thought it was going to be deep in trouble during COVID because I was like, who would want to live in a 350 square foot unit? I know most of the micro unit guys, developers, have a lot of common space that
makes it livable.
So you're not like stuck in a small space. But I think during COVID, obviously that stuff probably wasn't available to the tenants. So the common space. So I wondered how it seems like it all worked out. I don't hear anything about the micro unit projects all going into default or anything.
Tiny. Well, we can't exactly repurpose them without doing all the site work again. So it's certainly unique.
Yeah.
But I want to touch back on this. You brought up office. You like office for many reasons. Here in the Northeast, we're seeing office owners condo them out, start selling them. Pick up that cash. Is that something you're seeing in Illinois? Is this just a trend? What are your feelings?
No, I think the office condo business, I didn't see it come back even, after the recession, which it was a hot product. I want to say pre-recession. And I think the medical field, it still has some value. People can own their space, but Florida was a hot place for office condos, and banks and maybe the SBA and things like that were financing them. But I think it's a little tougher to finance that. The product didn't really appreciate it, never really has. We've seen these sort of, the condo hotel business, the office condo business, really never. There's booms, and then there's busts, and the busts are horrid. And it's a lot of, like a lot of things with a condo. The association is challenging, and the condo hotel business, I think it just never. I don't know if it's over aggressive pro formas but when you're buying an individual unit at 600,000, and when conventional hotels sell at 300,000 a door, it's going to take a lot for you to make some money in that one. I don't care who the sponsor is and how some of them work. I'm sure I'm over simplifying things, but my gut is in general that those product types they'll come back, because there's always some developer that brings them back, but I just don't think they're ever gonna there's gonna be like a office condo market like there is some other product type that medical office or whatever. We've data centers that seem to have some sustainability, and the sort of new emerging asset classes. I just don't see a condominium commercial condominiums as really something that I would foresee
shy away from it.
Well, it's how many times have we gone through this, and and it's Florida, Texas. It's like it seems more regional. Vague. I think that Nevada was a big office condo kind of place, and there's a lot of medical users, and again, maybe there's a niche for it. It's not, people want to own their space. They're going to be there for 30 years. It's better than having rent increases every year, I guess. But
for the owner, it's that lump sum cash, right? And they're not worried about defaults. Although you're saying the office tenants, they're paying. Everybody's paying. Yeah. People aren't in the office, so be it. They're moving forward, which is great news. That's what we want to see. Although although the majority of the workforce is returning to office, many have said that these offices need to now evolve into either newer buildings with healthier amenities, or simply smaller footprints to accommodate hybrid work. So for me, that's where I'm looking up and down our main avenues, and our opportunity zones are these larger office buildings, because they have that vacancy. Nobody's going to come in and take 10,000 square feet right now, from what we're seeing. So let's see if we can convert. Let's see if that owner is ready to give us that opportunity.
I think, we have a market here that's sort of a hot new market. New York, I think, had Chelsea for a while there, still does. It's called the West Loop, or the Fulton Market area, and tenants are moving in. They're coming from out of state. They might be coming from a suburban location. There is workers in that area. It's a hip. It's a lot of nice new restaurants and a lot of new housing, and it's a vibrant area. And office, there's a lot of new development, which is amazing. But I think mostly it's poaching from people in the old set, yesterday's hot market. So, or the loop of our area here that's really has really suffered during the pandemic. And so I don't know. I'm not really that bullish on office. I'm really would be cautious about getting into an office deal, especially one that had a significant amount of vacancy or a bunch of rolling leases. If the basis was right and it was well located, like everything, like our business, right? It's there's bad retail we could talk about. It's all about location in many cases, and obviously the quality of the building. Like you said, if a lobby that's tired, space that's tired, you better be just giving away that space for super cheap. And I think the one-story office flex had a lot of desire. during the pandemic because you had your own space, you weren't sharing elevators and all that. We'll see if that's sustainable. I think there's if the price is right, Office Flex is a good product, and I think it's worked. It's got to be just at the right value, right?
Well,
the right
absolutely. The numbers have to make sense
Yeah.
in any deal, and if you torture them long enough, they'll tell you whatever you want.
Exactly.
So, what are the numbers coming in the door that you're going to be excited about? What is that? What does the debt service ratio look like? Where do you draw the line?
Well, it's obviously the higher the better, but let's just go on the low end. I mean, we're not afraid of a deal that doesn't have coverage today. Again, it's got to be the right product type. And generally not many deals, that I see, unless they're super heavy transition, have, no cash flow. What I see on those deals is an industrial that lost a big tenant. The seller doesn't want to deal with it. The market's so hot, his basis is so low, he's going to sell. And my new guy, who's my borrower, is going to buy it, and he's got a mousetrap to fill up that vacant space. And again, my business is, if you throw capital at the project, and as long as it underwrites properly, it'll work. We should be able to fill a 25-foot clear industrial space in a decent market, because of the demand for industrial space is so great. And even if it's 30 years old or something, but if it's got some functionality, but we'll do that deal. Yeah, for sure. Obviously, we're underwriting to the pro forma at some future point in time. So we may have, under 1.0 coverage on an apartment, and that number is going to go down as tenants are asked to leave for the renovation process or whatever. And so, we just build in an interest reserve, or we try to, we assess what the life of the project is going to look like to the best of our abilities, and, structure the loan accordingly. But yeah, we want this, spreads have gone up a little bit for me, but the index has gone up. The index being, LIBOR, SOFR, now SOFR. And so now my overall yield is a problem for my borrowers. And we talked about that in the beginning. What we're looking at is, negative leverage. And if you buy some at a 5 cap, or you have a 6% exit cap, and you're borrowing at 7, it's not usually a recipe for, improving your IRR. It's a recipe for reducing your IRR. So, that's a challenge. And
so are you looking, are you taking a closer look at someone's track record, things like that, to make sure that they can perform and fill it?
All of us in the finance business, or if they worked at a bank, we learned about the 5 C's. And I don't think I can rattle them off just right now, but it's still relevant. Character, is one of those. And obviously, my borrowers are nationwide. I don't know them personally, and many, I'm not like a community banker, but you get a sense of somebody's record through what deals they've done. You check their references. Obviously, if they've accumulated net worth and liquidity, that's probably a good sign. But obviously, you want people who are good people. So we look at litigation and things like that, and then obviously if they've bought something, fixed it up, and sold it, 3 or 4 times. Obviously, we love repeat borrowers, just like every lender does, like every business practically does. But and we're lucky. We have a lot of repeat borrowers. We're working on several deals with one in the retail space, and they just do a good job. They know the tenants. In the retail business, especially, I think you've got to have the experience. Whether you have a great leasing team or you were a leasing person, but you got to know the tenants. You got to be able to go to the ICSC and go to the tenant side of the floor, and where they want you as much as you want them, because they know you'll deliver the store on time and meet their needs.
Well, and ICSC Vegas, for anyone who doesn't know, you should know. It's a great event. Certainly, ICSC has been a staple forever on your retail centers. And speaking of retail centers and the different tenants, you have your national franchises. You're coming in strip centers, fantastic. Pull in, pull out. Pandemic only helped this. Now, at least here again, Northeast, I live in Shelton. I love Shelton. Taxes are down. People are looking. There's some vacancy, but every owner I've spoken to that has one or two vacancies, they're not worried. They'd rather leave it vacant because they have these triple net tenants. And I put that in quotes because triple net to different people in different parts of the country is a different thing. But in essence, quality tenants, quality rent roll, quality history is what you're saying. Those are the three big ones for you. You've got the background, you've got the rent roll, you've got the cash flow, and you're not a criminal, or at least not in real estate.
Or highly litigious, or do banks every time you can. I think retail is certainly the mall space is not one that we would be involved with, but is giving sort of retail a bad name. I think retail is much more bifurcated than the headlines sort of lead you to believe. I don't know. I think you drive past a strip center, even some power centers, and they're packed every weekend, and even malls to some degree, that are still have some vibrancy left to them. So people, we'll see with the recession, inflation, and all that, but certainly I think look at sales for some of the grocers. I mean, just exploded. And people are eating at home, obviously, and so they'll see some retraction there. But at the same time, you've got some big box tenants who I think maybe were able to buy some time during the pandemic with discounts on their rent or shop from home or whatever it was that were able to sustain them. But I think they're going to be facing the music. I think I don't want to mention any names, but I think there's been some headlines, at least one relatively giant company with big box, multiple big box stores that's
closing down.
That's going to be in deep trouble, and their stock is melting.
So, and we're getting close to the top of the hour here. What is your take on gas stations? We're committed as countries all over the world to get to net zero carbon emissions. Great. Gas prices are soaring.
Yeah.
Is that an asset class?
I'm amazed that there's expansion and this I think like Wawa I think is still going crazy relatively on space. I mean it seems counterintuitive to the electric vehicle a revolution that apparently we're all going to be facing, but I'm obviously want to see the climate be in a better place, and I support electric vehicles. I think I'm probably more in favor of the hybrid model, and so I think the gas stations are not dumb, and certainly Wawa is not a dumb company, and BP and others, and so either they're going to have charging stations at those. One of the things I did hear, and I'm not sure, I didn't verify it, but that because it probably takes a little bit longer to charge, and who knows what the technology will be, when you're pulling in with your EV, 4 years from now, but because it does take, I guess, a little bit longer to charge your vehicle, that the convenience store actually has more value. And obviously, or for those of us who know anything about the gas station business, the money's made in the store, not at the
pump. Despite what you believe, it's all the cup of coffee.
Headlines,
yeah.
So you throw a slot machine or two in the gas station, in the convenience store, and things like that. It could be, maybe a different business model, which is beneficial to them. But I'm as shocked as anybody that there's more gas stations. Not, it's not like every day, but there's, one on the corner by me that just is opening, and I think 7-Eleven's expanding. Obviously, they're more of a convenience store than a gas purveyor, or gasoline purveyor. But I'm not, with credit on the lease for 20 years, I'd have no problem with it. Making a loan on one.
Well, love that. So inland is always developing. Inland is clearly lending.
Yeah.
You're busy at work, which is fantastic.
Yeah, inland, and the rest of inland is very busy. It just, I think I just saw a statistic, 1.7 billion of assets acquired. So This campus is buzzing with business occurring constantly.
I love talking with anybody at Inland. Your story, your culture, the speed and accuracy at which you execute on transactions is fantastic. You spoke about South Florida before, and I remember talking to different brokers. You guys showed up in January, and by Christmas, entire centers had been turned over and fully leased up at one point. So it's a great thing to see you guys operating at this level as you always have, which is fantastic. As far as what to look out for here at the top of the hour, if you were going to give one piece of advice to the developers out there, the people looking to borrow money, what is that big piece of advice as we head into the fall here?
It's the same. It's the same. I tell them whether the economy was great or not. It's location. It's obviously capitalizing your property properly. I think we've seen it through, now my 4 down cycles like we talked about. If you need patient capital patient capital always wins. It seems like, they make a mistake. They buy a property just in the wrong place. I don't care how patient their capital is, but generally these sites, and I think we've seen it with banks, the way they handle their customers. You're seeing more kicking the can and things like that. It's the assets hopefully you lent on were solid, and when you're buying them too, if you make the right decisions in the right locations with the right underwriting. If you push for in our market, let's say $4 a foot, multifamily rent, it's just you're stretching, and I get it. You got to deploy capital. You believe in the market, and you think you can push rents up that high or whatever. But if you're the only guy doing it, it's tough. I mean, I'm not a developer. Obviously, I get a check every 2 weeks. I'm a little different, but I come at it from the lending side. But I would definitely, fundamentals are super important. I think they guide, my decisions, and I hope they do, and the folks who I lend to, and the folks who I think are sustainable in this business.
So, and it's middle of the herd, right? Don't try to overreach, and that's the best advice out there. As much as we want a grand slam on that on our
and hey, if you're new to the business, or you want to put some money into a property, you've been a leasing broker, you want to buy something or whatever, you're not probably going to have the luxury of patient capital. You're going to take the capital that you get within reason, and unfortunately, it's probably going to be, hey, I want my money back in 3 years or 2 years, and that's just the way it is. But luck never hurt anybody to hit things at the right time. But I think ultimately location will get your money back and then some. And obviously you got to work hard. You got to do the right thing on the property, and you can't be lazy. You can't waste time.
It is work at the end of the day. It's not
making money has never been easy for most people. So
it's an interesting thing how easy people think it can be to be a broker, to be the lender, just to be the developer.
I hear. I mean, and it happens in retail mostly because I think it's one product type that most people drive in and they think it's nothing. But there's so many people that say, I'm going to buy the shopping center. I'm a doctor, and I'm going to you work like 14 hours a day doing what you do for a living. You're going to let I guess you can hire third parties left and right, but it is way tougher than that. I can't articulate it any more than that to say that you can just hire, even the best leasing broker. It's you need to be on top of your deals.
And borrowing aside, if you're going to invest in real estate, why not invest in a TST over there at Inland, where they manage it for you? There's a shameless plug. Although I'm a firm believer in not just that, but fractionalized ownership interest in all the new vehicles that are coming. There are ways to invest.
Yeah, if you want to be a passive investor, Inland's a good place to talk to. They will do the work for you, and they will do a good job for you. But if you're on your own, you want to be a passive investor, and it's your money, and you're going to be the 100% owner. I'm not a big fan of that.
100% headaches if you're the 100% owner. So,
right.
That all being said, Mr. Mendoza here, man behind the curtain. We are at 5 minutes to the hour. This has been a fantastic conversation. I want to first thank you, Art, for coming on, talking, sharing everything you know, an insider view over at Inland, in the industry, 4 cycles, 4 downturns, not worried at all. Focus on your key asset classes, and don't overextend, haha, pun intended for you lenders out there, and to move into the space. So to reach you, at what point should I, as an owner investor, start reaching out to you? When do you, and how? We're going to throw up your information while you just talk through your deal.
It's we're quick, but it's still a process to get a loan closed. We're non-recourse, so we're institutional. So, realistically, 30 days is pretty fast. 45 is more the norm. And so I would say if you're, under LOI and you think you've got the deal, start talking to lenders. Just talk to me, but first, start talking to lenders about that time, because you're going to need to get estoppels potentially if it's not an apartment building, and there's just a lot of work. It's not just buying the property and there's a lot of due diligence that you're going to be doing as a buyer that I'm going to have to do, sort of piggybacking off of your due diligence as a borrower. So 40, I would definitely say as soon as humanly possible, you think you've got the property tied up, because you're if you need to close in 7 days, you're going to pay for it. Not going to be from me, but you're going to be paying for it from some other lender who's probably going to charge a lot of money for that loan. And if you're willing to pay it, then maybe you get a good deal on the asset. I don't know, but
it's funny you say it that way. Whenever I've recommended different lenders to investors, it's always, and I'm not going to name any of them at this point, it's, by the way, if this guy says don't do it, you probably shouldn't do it. But if you go to this guy, he's going to give it to you.
Yeah.
It sounds like, and from what I know about Inland, you guys are right there in the middle. If a deal is worth doing, you're there to do it. But 45 days, you got to build in the time. You've got to have that experience.
Inland has the ability, to do things faster than the buy side. And again, I'm the lender, so I'm in a different seat than a lot of people here at Inland. But from the lending side, it's realistically, can things be done quicker? Yeah, if the deal's not complicated. But generally, it's I would say 30 days at the least, and 45 at preferred time frame from application to close.
All right, and as we've said repeatedly, 3 to 15 million, give or take, a little smaller, a little bigger.
Yeah.
Great location. Reach out and start working with you.
Thank you. It was great. It was a quick hour. It went by fast.
And thank you. I want to thank our audience for tuning in. Please do remember to like, rate, review us, share, post. We are available anywhere you get your audio and on all major social media channels. Don't forget to tune in first Thursday of every month for the CRECo.ai Roundtable with all our hosts. And we hope to have you back, Art, for another sector interview. And looking forward to seeing more deals come out of Inland and more loans that you're right there doing.
That would be wonderful. I'm glad. Thanks for the time. I really appreciate it.
Thank you. And with that, Mr. Mendoza, will you lead us out?